Hi. Many investors, maybe some of you, are asking a lot of good questions during the crazy times we're all experiencing these first 5 months of 2020. Recently, we talked about why the stock market appears to ignore bad economic news and go up as disastrous economic numbers are released. Another question you may be asking is now a good time to invest? Why don't you join me at the whiteboard as we examine this question with a little peek back at history?
Some investors feel it's hard to know when to invest in the stock market. This can happen when the market has recently reached an all-time high or has declined by a significantly large percentage. When headlines are about record highs, investors may get nervous and assume that the stock market is likely to fall after they have invested. When the market has declined by a relatively large amount, investors may wonder how much further it will decline before it makes sense to invest. So here's the underlying question. Is it better to invest when the markets have reached an all-time high, or after they have experienced a substantial decline? Well, we can look at these scenarios with some historical numbers. Let's examine the S&P 500 from 1926 through 2018 to see what we can learn about the market's 1-year, 3-year, and 5-year performance following a record high and also after a 10% or more market correction. First, let's consider all-time highs. Looking at historical performance, we can see the S&P 500 has averaged about 14% in the following 1-year period. 3 years after a market high, we see an average annualized return of about 10.5%, and 5 years out, a 9.9% average return. Now, let's use the same data to look at how the market has performed after a 10% or greater decline. The average return has been about 11% for 1-year periods, about 10% for 3-year periods, and about 9.6% for 5-year periods. So what can we learn from this exercise? Well, first, the market's current level does not tell us much about its future direction. Second, after a market high or a decline, returns tend to average very similar over the intermediate period of time. It's what's called a reversion to the statistical average. So whether it is the best of times, not the best of times, or somewhere in the middle, every day there is a positive expected return on invested capital, and markets have rewarded those investors who have remained invested.
Thanks for joining us. If you have a topic you'd like us to cover, please leave a comment in the section below the video, or you can visit us at our website, www.luminarywealth.com. Until next time, stay safe and please live a healthy life.